Eric Will
Let's get it. What's going on, guys? Woods here. So I want to bring forth the demand anticipation lesson. That's what I call it. And I'm going to show you why. So we've gone over how to seek demand, right? We've gone over how to seek demand zones. We've gone over how I play the demand zones, how I would put my bids within that demand zone once you seek them. And we also went over playing order blocks, utilizing those previous demand zones. So what I'm gonna do now is I'm gonna show you another tool. This is a little bit more advanced, but this is something that I use to either proceed a trend, so the continuation of a trend, anticipating demand to form, thus anticipating the pump, or when a potential bottom has formed and anticipating demand from there. Obviously, the higher the time frame, the more confirmation you could get for that specific play. A little bit of a looser play you would have to play, but the smaller the time frame, the little less conviction you can have in it. Sometimes you do have to look at the lower time frame depending on how strong the trend is. And you play it like that. But what I'm gonna do is I'm gonna show you just a few examples, and we're gonna go through them together exactly how I would play them. In this Abe one, we actually played in the group a few days ago. If you aren't in the group, you'll remember this play. A little position, but it's played nonetheless. So I'm gonna do is I'm gonna take the replay button back, and what I was looking at Ave, I was looking at this little bottom type of formation. Right, we got this wick low here, so you kind of look at it and you're like, okay, my clear and validation. We could put a stop below this wick. We could put obviously a stop below that wick, but that would be pretty loose if you're looking at a play like this, right? That's a 12% stop. That's a 4.5% stop, and you don't have any sufficient evidence to say this is going to confirm a reversal other than this sweep and SFP, so the closure above this previous wick. And what I was looking at was I just want to see how this 4-hour closed. And because Abe looked kind of strong, what I saw here was I anticipated demand here. So let me actually take this replay button just slightly back so you guys can actually see what I saw. And what I saw was Abe came down, swept this block that interested me, right? And what happens after this is I'm just looking for this candle, this current 4-hour candle, to close over the last one. If it closes over the last candle, to me, it confirms demand. It doesn't mean that it's going to play out the way that I anticipated to. I can clearly take a stop loss, but it makes your invalidation much clearer because in my eyes, if this candle closes over the last candle, we confirm demand, meaning that any retest within the previous block should cause a pump and a move up, including other confluences as well. You want to use other confluences, especially if you can, all the time. We have, like I said, this SFP form down here, sweep below this wick, close above. We got the range break and potential flip happening here. And I use that all in confluence to say, all right, this 4-hour candle closes over the last one and confirms demand. So any retest is a buy. You enter with your stop below this candle wick, because if it goes below that wick, it can still be valid, but the whole point of this is to give you a tighter invalidation. And you can see this wick retest as well. So even though the candle after the confirmation candle pumps over, this one confirms it and the next one retests it. And then you can see how that leads to a pump directly after. This is the most recent example that I have for a play that I took. So I wanted to explain this as I saw it, because it is such difficult terrain to trade in the past few days or so. These are things that I look for, right? So again, you get the demand anticipation. So you need a candle closure over that block that you're anticipating to create demand. And then you enter with your stop below a specific wick that you see. There's no right or wrong way to do it, just whatever you're comfortable doing, however you see it. And it just makes your invalidation tighter. Like I said, if I wanted to take Ave around here, the play would have been a little loose. We would have been playing under this wick, which would have been 4.6%. We would have been playing below this wick, which is at 12%. It doesn't even make sense to do it that way. But when I got my confirmation for demand, potential bottom, range break and retest, looking for a move up and a reversal, we got a clear invalidation. This is a 2% invalidation. If we sweep below this wick, odds are we really don't even want the play. And yes, we can sweep below this wick and come back above, close above, so it still confirms the demand. And then we can look to enter after that, or you can play a manual stop depending on how you want to look at the play. But for me, this was just a clear and solid demand anticipation example. So guys, I just want to, I'm just scrolling through the charts. I just want to look at the hourly and see what happened most recently. And in the most recent price action, we've been crabbing. So generally, you're not going to find 4-hour demand anticipation examples like this, unless they're happening like right now. So I just want to look at the hourly just to see what we could find and what we could see. So, I mean, I just came across Alice right here, right? On this break and move up, we broke the range high right here, created a little bit of hourly demand anticipation, retested it, and pumped off that demand anticipation. So you would play it exactly how I put it on the Abe example. So again, you would, let's say, take out your long tool and put your stop below these wicks. So you're giving yourself about a 1.6, 2.2% risk about, and you get a good pop off this demand anticipation right there, anticipating that the demand is going to form. Again, they're generally more risky plays than confirmed demand, which means after a pump, you can then place your bids within the demand. These are anticipating the demand to form. So you're basically predicting a demand to form at your exact entry point or around it. And that's another. So I want to explain a few hourly examples because I want to look at the most recent price action. And in the most recent price action, since we've been crabbing for the past few days or so, it's generally a lot harder to find 4-hour demands. You might not even see them form, other than the Abe example we saw, or they're forming right now and anticipating them now. So what I want to show you is this hourly Atom one at the bottom. So right here at the bottom, we have, let's say we look at the 15-minute, just to tie in other confluences. Remember, you're going to want to tie in confluences. So whenever you can, right? So we got an inverse head and shoulder potential, right? I pull it up on the hourly, and we're going to see we break the range. So you could have entered anticipating the inverse head and shoulder lower time frame to play out, obviously. Broke that high, right? Came down, retested the range. Okay. And now we have even more confirmation to look for an entry around this level, right? We got this range high, right? We got the closure above this demand block. And so you're going to anticipate demand to form here, right? And to make it a little bit easier to see, I'm going to put my replay button back there. And now what you're going to do is any bid within this demand level is a buy. So you're going to enter your position, right, on that closure, target resistance, put your stop below the wick. So this one's going to be a little bit looser, but with this specific play, I would leave myself some room to DCA if possible. So I would enter here and look to enter majority of my positions around there. So you're going to give yourself about a 2% risk stop, a little bit more after DCA, and you're going to target a nice move up to resistance, given that the demand anticipation plays out and the demand forms, right? And we'll see how this plays out. I mean, obviously, hindsight, we know it plays out perfectly, but this is just to show you how it would have played out. Remember, the range break, demand anticipation after the closure above, you enter, leave yourself room to DCA. We didn't get any of the DCA bids filled before the play played out accordingly, right? And that's just a good solid example on the hourly, right? With the hourly, obviously you're gonna have a little less conviction than you would on the 4-hour, but it just goes to show you how you can utilize each time frame as you can, just looking at the charts. Tying another confluence, we looked at the inverse head and shoulder, so you could have even caught the pop there. We're looking at the range break retest, so there's even more confirmation to enter those plays, and you're giving yourself a logical invalidation to play that specific play. And like I said in the Abe example, obviously we can move down, sweep that low, come back above, close above, that can happen. But the whole point of the strategy is to give yourself a tighter invalidation, anticipating demand to form, and then the play plays out the way that you anticipated too. All right, guys, I'm gonna take a look at ball here. And the reason why I want to look at ball, like I said, the most recent price section has been very choppy, very crab-like, but I want to show you just how you can play these demand anticipations. And you might take a loss along the way, right? But this is just to show you how you can play it, right? So over here, we have the sweep of this low, come back above, demand anticipation right here, after the closure above this hourly demand block to a move up. So even though, you're not getting a crazy move up, but you're getting a 2% gain to scalp for about, remember, we're putting our stop below the demand block that we anticipate to form. So you're going to give yourself an extra, a little bit of room here, 1% to make 2%, right? That's a solid gain. You're anticipating demand to form, and then we get a pump off that demand. And just to show you guys again, I'm going to take the replay button now because it's always a lot better to see how the price action plays in real time. So we sweep those lows above the previous wick, tripping an SFP, always tying a confluence if you can, guys. So it's always important to do that. The next candle after breaks above. So you're anticipating demand to form here, thus meaning you're going to wait for the confirmation, obviously, meaning that you're going to enter right there. You're going to put your stop below the demand block that you anticipate to form. And you're already going to be in profit because the hourly began to pump. And you're going to target the highs over here. You know, we're crabbing around, so you're not looking to target crazy. Obviously, you would want to target that high, but obviously we know what happens there. So, and then the play would have played out accordingly. And a nice scalp. All right, and then you could see a reversal happening right here, lower time frame. You get the head and shoulder, so it would be a good telltale to probably take profit on this position. But it just goes to show you how you can play these demand anticipations, right? And now there's another one that forms that I want to play out with you guys right here. See if we can spot it together. Bam. So we did, you know, we had the lows test. Obviously, you can take a long route the lows, obviously. But then we got our confirmation that we're learning today, which is demand anticipation. You get the demand block. The next candle directly after closes above. So now you're looking to enter at around this close plus the retest. So let's say you have your entry right in between, and you're going to look to target those highs that you look at target previous. And even though you're entering higher than your last entry, it's okay because you're entering on more confirmation. This is a strategy in its own. You're going to put your stop below the demand block that you anticipate, and you're going to just allow the play to play out. And look at that. We risked 1%, and the play would still be running, and it would be up about a 1.7%. And that's just to show you how you can scalp these movements as well. Remember, the higher the time frame, the more conviction. You got to realize if we're trading in a range, is it an uptrend, is it a downtrend, have a directional bias, assume where the market's going to go, utilize your other complements, tie them all in, and create a play like this. You know what I'm saying? Like after sweeps like this, after we test the lows, it's a good telltale to say, okay, we've tried to break this resistance one time here, or, you know, 1, 2, 3, 4. So the fifth time around might break, right? So you might be able to hold that scalp for a little bit longer. If you see any reversal signs, you would want to take profit. And that just goes to show you how you can scalp these demand anticipations as well. All right. So yeah, guys, I'm just on a random, you know, I'm on a random chart on Dash out of all charts. And I just want to scroll through the chart just to show you guys a big reaction from a demand anticipation without even really knowing the price action of this coin or really knowing what it does. I don't trade Dash, just to show you guys what, you know, you can look at and how you can utilize these demand anticipations. And so, yeah, so right here, beautiful example. So let's say in this move up, you know, you got a clear uptrend. We broke structure here. So you got this little uptrend, broke structure to the downside, right? And then we sweep these lows. Beautiful. Perfect. Sweep the lows. And we close below. So people would be looking at this as a break of structure with the deviation below, right? We flip it back up. And what happens here is interesting, right? We're looking to reclaim the range. So the previous break of structure range low, we're looking to regain that after we flip above it. And what prints here? Okay. A beautiful demand anticipation example. So we get the closure above on the 4 hour. And what I'm going to do is I'm going to bring the replay button out of here again, because again, it just helps to see it. And now what we can say is, okay, so now it looks like we deviated the range low. So it trapped shorters down here. And now we're anticipating a pump on the 4 hour. So if this 4 hour closes above this candle closure, any retest is a buy. And what happens here? It just automatically pumps off that demand, giving you a few times to enter that position as well. And this just goes to show you like just how powerful this demand anticipation really is, because it's adding confluence onto your play. And we see another one here. This one is a little more tricky, but you can see right here, this demand anticipation right here on the 4 hour. Again, the wick highs are a little tricky, but you can see how the price crawls up and eventually pumps out of that demand right there. And yeah, that's just a beautiful example of just us just looking for demand anticipation example. What I want to do is, perfect. And yeah, so I just scrolled over to Dash a little bit more left in February, and just to show you just another example, we pump, we print demand, we close over that demand in the next candle over. So any retest, remember, any retest here is a buy, because now we're going to close this 4 hour over this demand. And you're at the range highs here as well. So you're at the range highs after sweeping the lows. So you're anticipating a break as well. But you have more confirmation to enter on that break, anticipating another leg up, because you have your demand anticipation on the 4 hour. So you're going to open up your rectangle. Any retest is a buy. So because the 4 hour closed above, you're going to want to begin your DCA there, but you're going to want to DCA because it is a little bit loose of a play. So on a play like this, you would definitely want to DCA, leave room for it, because that's a 2.6% demand level. So you're going to want to at least DCA to the midline if you can, and giving yourself a 2% risk stop below the level. You could do a 2.5%, 2.6, 2.83%, whatever you'd want to play, whatever you're comfortable with. And how would the play out? We would retest the demand zone almost fully, get all the bids filled that we're anticipating, because we're looking to fill halfway in. We don't want the whole level to be tested, because we don't even want it to test that low, because again, our invalidation is below the wick low of the demand block we anticipate. But I'm looking to just get all my bids filled to the candle closure of that demand block. And if you know how I do my support resistance, you know why I do that. So make sure you watch my support and resistance lessons, and I have another one coming soon, so keep your eyes out for that. And we would get a nice pump off that demand zone, and it's, you know, it obviously come back and it might cascade through, but at this point we should already take profit on a 7.4% move. This is just showing you how to play. Man, there's always a way to play within the cracks. I tell people all the time, there's things happening all the time. You just got to find it. If you miss a bottom, there's something to be had in the middle if you anticipate the move to continue. And this is just how another way to look at the charts, another way to look through within the cracks.
So many thoughts I can't fit on the page. Fuck it, this shit, I'ma shit off the brain. She said she like how